Hello, everyone. Thank you for your patience. We now have Peter and Hannah on the line. My name is Anne, Senior Wealth Advisor from Sanlam Private Wealth in Mauritius, and I will be your host this morning. Today's session will be a 20-minute presentation from Peter, followed by a 10-minute Q&A. May I please kindly ask that you keep your microphones on mute, and please use the Q&A button at the below to send us your questions. Again, we're very pleased and welcome you all to our session, which I trust you will find very insightful. Market swings and fluctuation in share prices have become daily occurrences amid the unprecedented times that we're living in at the moment. And we at Sanlam Private Wealth have our clients' interest first and foremost in everything that we do. And for this particular reason, we wanted to offer you the opportunity to speak firsthand and to hear from Peter, the fund manager of the Global High Quality Fund, about the fund's performance to date and the expectations for the remainder of the year and beyond. Let me introduce you to Peter, award-winning fund manager of the Sanlam Global High Quality Fund. Peter has been with Sanlam since 2012 and is the head of global equities and lead fund manager of the High Quality Fund. Based in London with his team, and we have Anna here with us as well today, Peter manages in excess of $1.7 billion and received numerous awards throughout his career and is regularly featured in various published articles. So Peter, after an eventful end of March for equity markets and the drops all investors worldwide have experienced, we have seen a fantastic recovery in the Global High Quality Fund in April. Where do we stand now?
Thank you very, very much for the question, Anne, and for the introduction. And thank you very much for the listeners for spending about 40 minutes with us today. On your question, what we've done, and we've just prepared a presentation which will take you through our different actions that we've initiated in the fund. And of course, the high in the market was around the 19th, 20th of February, and the low in the market was on the 23rd of March, and that drawdown was close to 35%, certainly more for some other markets. But what I'm going to do, just to set the scene, is to link you up with a presentation we've prepared. It's not too many slides, which will take you through our thinking and explain to the investors and the participants on this call how we navigated the current environment and also our thinking going forward. And so to that extent, I just want to introduce Hannah, the investment analyst working with me on the fund. Hannah, of course, well known to you, and she's going to just wrap it up for you, set the scene in terms of our quick recap of our philosophy and how we execute on that philosophy throughout the period. And I'll finish the presentation with some very stock-specific examples on how we use the volatility to our favor this year.
Hello, everybody, and it's a pleasure to speak to you all once again. I'm just going to share the presentation screen with you now, so hopefully you will be able to see it okay. So I'll just do a quick recap over our strategy just to set the scene, as Peter said, and we'll talk about how we invest and then how that strategy has come into play during these really interesting times that we've seen so far year to date. So as Anne said, we manage in excess of $1.5 billion, and that's split between institutional funds such as the Sanlam Global High Quality Fund and also in segregated mandates. But all of this is managed to the same global high quality strategy, the same investment process that Peter has been employing now for over 13 years, and since his time at Sanlam in September 2012. There's a team of 6 of us that manage these assets in London, and we're very happy to have received a number of awards and industry recognition for the management of these assets, including so far this year another FE Manager award for Peter, which is awarded to the top 10% of fund managers across the whole retail-facing investment industry in the UK, across all asset classes, on the basis of risk-adjusted returns. We've also had the Private Asset Managers Award for the high growth portfolios in our segregated mandates, alongside a number of other awards such as Investment Woman of the Year for myself and the Investor's Choice Award, which is risk-adjusted returns over a 10-year period. We are at 1.5 billion, the leading and the flagship global equity capability for Sanlam. And we're very well known within the group, and we've been building our presence, as you know, throughout various other jurisdictions across the world. And I've had the pleasure to meet many of you that are on the call today. Just to cover back over our investment process, which many of you are familiar with, we're a long-only global equity fund investing in quality businesses from a global universe at attractive valuations. And when we speak of our universe, of course, we can't cover the whole universe. So we screen that down. We look at various different quality measures, and we'll talk about that because that's what's been really interesting so far this year. Is it's really separated the sort of the wheat from the chaff in that sense. So companies with a lot, particularly under balance sheet pressure, have come under real strain so far this year in the pullback. And we'll look at the different sector returns as well. There are large parts of the market that we don't invest in because they don't embody the quality criteria that we're looking at when we invest in businesses. So when we do this screen down, and we have our watch list of quality names, this is where it's really important. We have to remember how our process works, is as those names may or may not come into be in value at any point in time, but they will all be quality businesses that we wish to own at some point. And this is where this year has been very interesting for us, because a number of those names that were overvalued, for example, things like Accenture, SAP, had then come into value for us as a result of the pullback in the market. And that's allowed us to enter new positions in names that we may have previously owned before. So if we sell out of a position and we still believe in the fundamentals of that business, it will go back onto that watch list of 120 names. And this is why it's important that we just frame back over our process before we talk about the different things we've done so far this year. But we're looking at the when we're looking at the quality of the business, we're looking at various different metrics. We're looking at the sustainability and durability of the economic moat of that business. We're looking at returns of capital, returns on equity, and we're looking at balance sheet strength, just to mention a few of the things that we're looking at. But from a valuation basis, we will not invest in anything that trades on a less than 4% free cash flow yield 2 years forward. And so when we find that we have these pullbacks in the market, we suddenly find a number of those names on this watch list come into value. And that helps us to build our concentrated portfolio of 25 to 35 names of high quality businesses at attractive valuations. So if you look at the sector returns year to date, and what I've done here is I've highlighted those sectors, those large parts of the market that we don't invest in the fund. And that is because they're not typically befitting of our quality criteria. And so if we look at something like returns on capital, sectors like utilities, energy, financials typically won't have those high returns on capital in the businesses that form parts of these sectors. And something like financials was down 29% in March, energy sector down 22%. They got very hard hit, and a lot of the companies that form part of these sectors do have high gearing, they have high capital expenditure, and they do have balance sheet strain. And those are things that you won't typically find, we won't find in the fund, invested in the fund. So you can see there through that graph that's highlighted, those areas in blue are the sectors that are held within the fund, and the areas in orange are the ones that not. And so you can see there, just by avoiding businesses that aren't of that quality, we've managed to actually avoid, despite the fact that our sector positioning is entirely a function of the bottom-up selection, we managed to avoid large parts of the market that became under particular strain during March in particular. So I spoke about our active management, and we do have a long-term time horizon. We have low portfolio turnover, as many of you know, but we are actively managed, and that means that when we get these situations where we have undue amounts of volatility in the market, we can use that as an opportunity to invest in these quality businesses at the attractive valuations that we require for entry in the portfolio. Accenture and SAP, Heineken are three really fantastic examples of this. So got Accenture, a global leading software business. It has been in the fund before, along with SAP. We sold out of them many years ago, and they went back onto that 120 stock watch list because they were businesses that we wanted to invest in, but we just couldn't stomach the valuations that they'd moved to at the time. And we got the opportunity to invest in them in March. And SAP is a really good example. If you look there on the far left group, and then there's one box further over to the right, so exited based on valuation principles. When we purchased SAP, we bought it at a 6% free cash yield 2 years forward. It had a 30% move during the bounce back, which that free cash yield moved down to 4%, which meant that we sold the business. And now the holding period was very short, so probably about a month, and that's not typical for us. I have to reiterate that's not typical. We tend to look at a 3 to 5 year time horizon, but when something has that kind of move in the context of where we are, we will be active and we will sell out of that position because we just won't hold these businesses at any price. And Peter will speak more about that later. We do have some slides on that later. Allergan is one. It's actually a big contributor for us so far this year because we sold out of it back in January following a bid. So, and it has since pulled back significantly. Going on to position increases. So it's not just entering into new positions that's important for us. It's also being able to increase those positions that we already have and that we have the conviction in the portfolio. And Facebook is a really good example of that. It's had fantastic results recently, but of course it had this sort of 30-odd% pullback during March, and we were able to add probably at least a third of the position over again during that pullback because it gave us really fantastic entry levels to be able to do so. The same story for Diageo, which we nearly doubled the position in, and Alphabet as well. Intercontinental hotels, Peter will speak about this later, but that's an interesting one again because that, given the pressure on the hotel industry in particular following COVID-19, got hit very hard. But we have seen since an incredible sort of 60-odd% bounce back from the lows in March, which we've been able to participate in by increasing that position size. Because now 90% of their hotels in the US are open, something like 97% of their hotels in China. So we are seeing, when we look out, despite the short-term pressures, we are seeing recovery in these things. And we do have faith in the business as a whole and the fundamentals to recover. We've also had some good success stories in being able to reduce positions in the fund as well, which is just as important. And things like Reckitt Benckiser and Johnson & Johnson have really followed that healthcare and hygiene trend this year and have done very well. Tencent, Reckitt and Johnson & Johnson have all outperformed the market on a relative basis by about just less than 20% so far this year. In a negative market, they're all up nearly or in excess of double digits, which is a very good result. And Peter will speak of that later in the presentation. Samsung is one that we had the opportunity to reduce at the start of the year, and following that has pulled back more significantly. So that's something that's worked very well for us in the fund. So when we have a look at the performance, how has this turned out for us? And what I would firstly like to reiterate is more that we have a long-term time horizon. That's what's important to us, that 3 to 5 years and beyond. But of course, to be able to protect on the downside in the near term for our investors is something that we're very pleased about. And we only captured in the region of 70% of that downside in the market. We were 4.5% ahead of the market as at the end of March, and you can see that we've continued now that outperformance, particularly when you look against the market and the sector average. So your average global equity fund, the IA Global Sector, particularly over the long term, it always staggers me that the challenges faced by how difficult it is to actually outperform that market in the long term. But we're very pleased to be able to have protected against the downside so far in this year in the market and position the fund, invest more in these quality businesses that we wanted to own in the process of doing that. And if we look at these returns now over the longer period, so this is our track record now, which I spoke about across the last 13 years of Peter's investment. So over 1 year now, we're only down just less than 3% in dollars. But if we look at over the longer term periods, that outperformance is of course compounding away. And that's something that we're very pleased to be able to have achieved over the long term. this strategy does, of course, include 2008, where we finished the year 33% ahead of the index. So it's just another situation where when you see these severe downturns in the market, the strategy does and has typically performed very well. So I spoke a lot about how we'd managed to increase these position sizes, and you can see this now when we look at the top 10 holdings in the fund. And I'm going to bring Peter in now here, because we have I spoke about Alphabet and Facebook and how we were managing at very attractive levels to be able to significantly add to these positions. Tencent is something that we've recently been reducing. It's done very, very well for us, and I think I'm going to bring Peter in here if you want to explain some of the more recent activity you've done.
Thank you very much, Anna. That makes my job much easier. So, Anne, just to come back to your question, then, as Hannah explained there to the audience, it's always for us the ability to focus on a fixed universe means that we know those companies really well, and we will be very, very patient to enter positions. So when we look down that top 10, you can see a name like Alphabet's been there, over 5 years now, and has tripled over that time period. But we have actively, reduced those positions. Back in January, we reduced it at 1474, and we were managed to buy quite aggressively back at $1,100. Big moves in big businesses. And Tencent was a business last year that we bought aggressively towards the middle to the third quarter of the year, and subsequently has rallied about 38% in a market that's almost flat over that period. So just examples of businesses we've held. Diageo we've held for over 10 years in the strategy, but it was a very low position of about 1.8% up until the end of March, when we started buying aggressively into that business as it approached the 6% free cash flow yield. And then some of the newer names in our portfolio, Bayer and Intercontinental, they have more cyclicality. Certainly Bayer Corporation with their crop science division is subject to more forecast risk. And Intercontinental, of course, when we look at attribution, we'll talk a little bit about what hurt us. But that is a name that we think, if the recovery is there, then a lot of bad news has been priced into that name. So we have a very good combination of more cyclical businesses like Bayer and Intercontinental, but your great growth businesses, your stable growth businesses like Diageo and Alphabet still features as the top 10. So just to illustrate some of those returns, this was right up to the close of business, not yesterday, but the day before. And there you can see the two new positions, SAP, the big bounce in that stock, which causes us to exit that position. Now, I want to frame back in a 6-year period, the market's up about 35%. We are up, in the mid 50s, so strong outperformance, but it's not a typical example, SAP. It's absolutely a typical example of a great business we want to own. All the features we're looking for in a business, but the realities, as Hannah explained, it's just the cash flow yield collapse after that rally. But Roche is a business that we've owned for over 5 years, and it's been a fantastic outperformance for us. Probably for 4 years, a drag on the portfolio, and it just illustrates our time frame when we think about stocks. The massive outperformance all happened since June 18. In that name, it's a name that's now sought after by investors as a great growth business and a very stable balance sheet. Very briefly on the bottom performers, I think it's always important to highlight what's gone wrong. It illustrates clearly in terms of Intercontinental, Sabre, and Bookings. That's travel-related companies, so clearly that's self-explanatory. General Dynamics owns Gulfstream, which is clearly going to get hit, although they had a $2 billion backlog of orders for their Gulfstream division, and the defense business very stable. And then with Anheuser-Busch, you have a very large EM exposure, so our long-term investors will, of course, know that we do get exposure to the emerging market consumer through companies like Anheuser-Busch. Unfortunately, the Brazilian real's just been really, really weak. And has hit that business, but the evaluation along with Heineken very attractive now. So we're just going to spend 5 minutes quickly to leave it over to questions and answers. So there's your Accenture graph. You can see there towards the back end of March how that valuation collapsed. Accenture is a big player and the major player in the process of helping companies to digitalize their business. If ever there was a need to do that, of course, this COVID-19 scenario has just emphasized the inability of companies not to digitalize will actually hamper their growth. So Accenture's business is doing just fine, but of course it's going to get hit like most businesses with a slowdown. But we're watching that stock carefully. We have a price target of 195 with a current value of 180, and we were buying in the mid 150s. Heineken, a position that, as Hannah's explained, it's been on our watch list for a decade, and we finally were able to buy this company at a close to 6% free cash flow yield. It's still early days for us. We entered that in the mid 70s. That's where it's currently at. It hasn't participated in the bounce. It's our cyclical businesses that's participated in the bounce. But from our perspective, these companies can be very, very good long-term compounders if they can continue to grow their top line 4% and their cash flow by about 8% per year. We've explained the SAP. It's my last example. You can see there, I've got the discount there versus the peer group. The peer group includes companies like Amazon, Microsoft, Intuit, companies that are very expensive. They are faster growing businesses, but we just believe that SAP's a very solid, in terms of enterprise resource planning. They are the leader in the world, very competitive offering, 30% margins. We had our opportunity, we took it, and unfortunately, we had to move on and looking at other opportunities instead. So, and just come back to your question then, in the short term, when you look at the amount of, and these are in trillions, so of course those are the ones with, I think, 12 noughts behind it. These are really, really massive numbers. So in the short term, we know that if you throw liquidity at the market, then perhaps everything will bounce. And we've seen, areas of stress in the credit market respond quite well. If this rally continues, a cyclical rally, you might expect the fund to lag a little bit. We've seen that ever so slightly in April. And that's because we're not buying into the distressed areas of the market. So the Fed is helping distressed areas of the market in the short term. But what matters in the long term is earnings. And when you look at that black line, you can see their earnings estimates have been coming down aggressively. Now, clearly for our businesses, those earnings estimates have been cut a lot less. In the very long term, earnings follow, share prices follow earnings, and follows those businesses which are truly great businesses, which we believe there are 120 of. And if we can stick to our knitting and focus on that select universe, then we can continue to do well by seriously avoiding the big losers in the world. I've thrown down there the old argument about growth versus value. We are value investors. We want to buy companies that are in value. We don't want to overpay for value. And we were talking about the discrepancy of growth versus value when we were down in Mauritius in January. And we're less worried about the spread between growth and value valuations. We are interested in what our businesses are trading at. And you can see that spike towards January, February. Just that's why we were selling down names like Google, Facebook, Samsung at the time, and we were just holding back and waiting for an opportunity which came. But you can see that re-rating is quite sharp. So to put a forecast on, and to be honest, would be not fair, because who knows what's going to happen. But clearly the big bounce we've seen is now taken away some opportunities, but we're still hopeful that as we rotate the portfolio into more attractive names, that we can continue to outperform the market going forward. I think I'm just going to let
Yeah, so I was just going to say, just mindful of the time here. So based on what you said, treated with respect, volatile markets are an investor's friend. Would you agree that now is a good time to invest into equities?
Look, I think it's very important to analyze what has really driven the markets over the last 5 years. And if you look at the US, you see the Nasdaq index up year to date, emerging markets and Europe down 25% for the year. It's been a very it's been very, very big dispersion of returns. And if you didn't own, and I get asked, why don't you own Amazon and Netflix? Well, if I did own them, then of course, for the benefit of hindsight, you could have had, even higher returns. But we are value investors. We don't want to overpay for growth prospects. I think the ability of those names to continue to drag the market higher when they're at very low free cash flow yields probably limited. So we are very happy. And there was an article I wrote in TrustNet about how the headline said we're happy to underperform in a big bull market. Now that's probably putting it too bluntly, but we're very happy that we are not going to get sucked into investing into growth businesses that have great prospects, but where we have to overpay. And when Hannah, prepares the slide that I've got there open in front of me, we maintaining that valuation discipline. We believe that our businesses over a full cycle can grow at 6 to 8% per year. If we're buying that at 6% free cash flow yield 1 year forward, with a big drawdown in earnings this year, then that's the sort of algorithm we're looking at. And really the market return over the last 10 years has been very, very low outside the US. So if we can start to rotate away from the US and find value elsewhere in the world, then hopefully we can continue to do really, really well in a very risk-controlled fashion. I mean, our volatility is much lower than the market, but we don't want to become momentum investors, and we certainly don't measure ourselves against investors who are just buying growth at any price. That really is our mantra, so that we don't want to overpay for growth. So I think, given the valuations we're at today, and given what Hannah's prepared here in front, you can see there that we're very comfortable that we're maintaining our discipline as we've always done over the last 13 years.
And that's it's precisely in line with some of the questions that we've been getting about the equity markets being overvalued the past few years, and finding new opportunities to get into the market with a good longer term returns have been difficult. But I guess, like you mentioned, the reallocation to companies with strong, solid balance sheets is something that obviously that you look at very closely.
Yeah, I mean, it's, as Hannah's highlighted, we did not decide back in January when the virus came that it's a good idea to actually invest in strong balance sheets. It's always been, our philosophy without fail. So from our point of view, it's just important to note that we are not victims, so to speak, of market events. We do things in the way that we do because we believe that at times of strain, then your truly weak businesses get exposed. And clearly, a black swan event, I feel a little bit of a victim because I've lived through 2007 and now 2020. I feel like I've had 3 black swan events now in my career, and I've certainly had enough of it. But they do illustrate to me that if you are going to invest only on cheap valuation, then you'll get brutally exposed in a black swan event. If something goes wrong in your business, it's better to pay a fair value for a great business and let those returns compound for you over time. And Buffett highlights that again in his AGM this year, where he talks about the 3 requirements: high return on capital, competent management, hopefully not cheat, and then the last requirement, and pay a fair price for it. And that's been the problem for a little while now in the market, that a lot of great businesses have been overvalued, but we're watching them and we're very keen to get exposure to them when they hit the right values for us.
And I guess just conscious of time now, we've been flooded with questions from the attendees, but I guess the recurring question that I've seen here: what would you say to our investors right now who are concerned about the equity portion of their portfolios and global equity markets in general, compared, looking at your fund and in terms of your performance with the index? We've seen a slide earlier where we've seen the comparison to the index that you've done really, really well. So I guess what would be your closing word to our concerned investors right now?
Look, I would say that you don't have to worry. I'm always more stressed than anybody else about making sure that we, don't invest in businesses that will lead to the ultimate sin, which is a permanent loss of capital. Return expectations, I've been quite frank, hopefully, in my conversations with, during my time at Sanlam about return expectations. And when we look at the required returns that we use in our cash flow models, that's close to 9%. We always debate whether we're too conservative. The higher your required returns, that will depress the present value of your cash flow. So we try to be conservative in our forecast. And when we look at a business like Heineken, it's again a typical example of, most investors look at Heineken and say, well, that's rather boring. Why don't you find us some nice sort of e-commerce company in China instead? Well, the forecast risk is so high, and so we just believe that if we're buying a great business like that will eventually recover, because people will start to drink beer again once we're out of the lockdown, then we lock in a 6% free cash flow yield, which will grow close to double digits over the long term. And if the stock maintains that rating, then that's the sort of return algorithm, 7 to 8% that you'll get over time, by being patient and by not selling out too early when the stock finally starts to perform. So it's about time horizon, patience, about a realistic return assumption. But do we have a better crystal ball than anybody else? No. That's why, and that's why we're not adding yet to a name like Intercontinental or Bookings Holdings just yet, because the reality is we have no better forecast than anybody else when that business will turn, but we've got a decent enough exposure that when it turns, we're comfortable that those businesses will finally perform for us.
Fantastic, Peter. That was very, very insightful. I'm just mindful of the time here, but what I will do is I'll gather all the questions, and by all means, if you have any more questions for Peter, please don't hesitate to send me an email. I'm in constant communication and contact with Peter and Hannah, so I'll be quite happy to be the liaison and get to your questions offline. But I want to thank you very much for your time this morning. I hope everybody, I know I enjoyed it very much, and I hope everybody else did too. In the coming weeks, perhaps we can have another session, but I'll be in touch. I'll be in touch for that. But I guess on our end, I just want to thank you very much for your time this morning, and we will be in touch very soon. So as always, keep sending us your updates, and I'll make sure I'll pass that on to our clients.